Hey everyone, and welcome back to your quarterly deep dive into the San Jose housing market with real data. It's October 2025, and we're breaking down the numbers for the third quarter. If you've been watching the news, you're probably getting mixed signals. You hear headlines about economic uncertainty and a housing crisis, but then you see home prices here in Silicon Valley holding strong. What's really going on? Well, I recently attended a talk by economist Dr. Christopher Thornberg, who taught at UCLA, and his insights cut right through the noise. Today, we're going to connect his big picture economic analysis to what's happening right here on the ground in San Jose. We'll start with the national and state trends and then drill down into the hard data for San Jose, comparing this quarter to the last 2 years with some perspective to pre-pandemic. So let's get into it. First, let's set the stage with the national economy. The biggest takeaway from Dr. Thornberg's talk is that there is a huge disconnect between the negative narrative you hear on the news and the positive reality, which is supported by data. Households are financially strong. While consumer sentiment is low, the data shows that American households are doing very well. Net worth is at record high, and the debt that we have as a percentage of the GDP is low. This financial health is the bedrock supporting the housing market. People have the resources, which prevents a widespread collapse in demand. What's the real risk to watch? Well, the immediate threat isn't a recession like you keep hearing about. The long-term risk Dr. Thornberg flagged is our national deficit, which is being propped up by foreign investment he calls hot money. If that foreign money pulls back, interest rates could spike. And he said the key indicator to watch for this is the value of the US dollar. If it starts to drop sharply, that's a warning sign. For now, it's stable, but it's something to keep an eye on down the road. So why does this matter for San Jose? Well, it tells us that despite higher interest rates, the fundamental economic picture for consumers is solid, which explains why we aren't seeing a major price correction. Now, zooming into California, Dr. Thornberg argues we are completely misdiagnosing our housing problem. He says it's a supply crisis, not an affordability crisis. This was his most important point for our market. The reason prices are so high is not due to affordability issues or the elite only buying houses, but it's a critical shortage of homes for sale. He says Sacramento is wrongly focused on affordability and inequality instead of the root cause, which is we simply don't have enough housing and we don't build enough housing. Plus, the lock-in effect is real. The market is frozen because so many homeowners have those 2.5% or 3% mortgage rates that they will not move from. Dr. Thornberg explains this breaks the filtering process where people would normally sell and move up, freeing their home for a new family. This lack of liquidity is choking our inventory. And it's not just with new homes, it's also older baby boomers who are staying in their family home even longer, not moving out and downsizing to allow a younger family to move into their large family home. So we've got a supply crisis in many different directions. Also, he mentions in California that the tech bust is a total myth. For us in the Bay Area, this is crucial. He says tech isn't busting, it's transforming, which is of course driven by AI. While some low-end tech jobs have disappeared, tech wages in the Bay Area are actually growing faster than anywhere else. And there are more tech firms here than ever before. And of course, tech firms that are also focused on AI. This high wage growth continues to fuel our local market. So the takeaway for California is that our problem is a chronic lack of inventory, which keeps a floor under our prices. So with that in context, let's look at the actual numbers in San Jose. I've analyzed the data for the third quarter, that's July, August, and September for 2023, 2024, and right now in 2025. So here's the breakdown for San Jose. The median sales price in 2023 was just under 1.6 million. 2024, it climbed to 1.638 million. And today in 2025, our closed sales averaged at 1.642 million. That shows a stable, slight increase where prices have remained incredibly resilient, confirming Dr. Thornberg's supply side argument. Despite our higher rates, the lack of homes for sale is keeping our prices firm. Now let's talk about the total number of homes sold, because this is another perspective about that point. 2023, 815 homes sold in Q3 in San Jose. 2024, 863. And in 2025, it increased to 919. So demand remains strong. It is actually growing. More homes sold this quarter than in the same period of the last 2 years, showing buyers are adapting to the current market. Now, our average inventory paints another interesting picture. Q3 2023, 232 homes for sale in San Jose. 2024, 301. And just these last few months, 389. Our inventory is increasing, and this is a key metric, with inventory up nearly 30% from last year and 65% up from 2023. Now, while this inventory is still low historically, which we'll talk about in a bit about 2019 data, this does show our lock-in effect may slowly be easing, giving buyers more options. Now, another metric I like to follow is the average days on market. 2023, 17, 2024, 18 days, not much difference. But in 2025, all the way up to 24 days on market. So we are seeing that slowing pace of homes taking about a week longer to sell. This is a clear sign that the market is normalizing and buyers have more time to make decisions and less of that frantic pace to deal with. And our last metric, which is a really good insight into the intensity in the market, is a sale price versus list price ratio. At 106% of asking price in 2023 to 4.7% over in 2024 to just 2.5% in 2025. The days of massing bidding wars driving prices 6% over asking are just gone. They're fading away. While well-priced homes still sell for a premium, buyers are facing a more rational bidding environment with less competition. So these numbers tell a story of stabilization and normalization. The market isn't crashing. It's finding its balance. And yeah, it's a little slower than recent years, but it's healthy. The rising inventory and longer days on market are healthy signs, giving buyers more breathing room to make decisions. Now let's talk about today's market versus 2019 pre-pandemic. Let's do that reality check. Although the comparison to the last couple of years is valuable because it gives us insight into what you might be feeling or hearing in the data, it's really important to understand the massive shifts our market have had over some time. So we need to rewind that clock to before the pandemic. I pulled the data for the third quarter of 2019, so we're comparing apples to apples. And this is what a normal pre-pandemic market looked like. The comparison is staggering. 2019 Q3 pre-pandemic, what do you think that median sales price was? It was $1,083,000. And if you recall, in 2025, we said it was $1,642,000. That's a 51% increase in just 6 years. The median price in San Jose has jumped by over $550,000. This reflects the period of low interest rates, massive stimulus, and the wealth generated in the tech sector over those years. The number of homes sold in 2019 Q3, 1,247. And if you recall, this year was 919. So we're getting closer to that healthy pre-pandemic normal. And of course, we're seeing an increase from the recent years, but we're still quite a bit off. That's 26% less than we saw in 2019. This is a critical point that perfectly illustrates Dr. Thornberg's liquidity argument. Nearly 27% fewer transactions are happening, and the market is significantly less active because of the lock-in effect keeping people from selling. Now, the average inventory in 2019, 587 homes, compared to 2025, 389. So that's still 33% off of our normal pre-pandemic market. This is the supply crisis that has been talked about in a nutshell. The data supports it. There are a third fewer homes for sale now than the normal 2019 market. This is the primary reason prices have remained so high. And our average days on market has actually decreased still from 2019. 2019, it was 30 days. And again, we are up to 24 days. So we're still selling homes 20% faster, even with today's higher interest rates. And, that shows just how intense the competition is for fewer homes that are available. And our last metric, that overbidding metric of sales price to list price, 2019, 100.6%. And in 2025, it was 102.6%. So buyers today are still paying a higher premium over list price than they did in 2019. The market is fundamentally tighter, and more competitive due to the severe lack of inventory. What's the big takeaway from this? The pandemic era didn't just raise prices, it fundamentally broke the normal flow of our real estate market. We now have less active, lower inventory, but more competition in the market than we did pre-pandemic. Now, this isn't a bubble in the way that Dr. Thornberg described the 2006 housing market. This is a structural crisis of scarcity. The demand, fueled by strong local tech economy, is still here and strong, but the supply has been choked off, not just from the lack of current homeowners moving, but also uniquely a South Bay problem of extremely limited land to build on. This historical context is key to understanding why our market continues to defy expectations. So let's put this all together. And what is my advice for the fourth quarter and beyond for buyers and sellers? Well, for sellers, the sky is not falling. This is good news. The fundamental supply shortage Dr. Thornberg described is protecting your home's value. However, the market has clearly shifted from the frenzy a few years ago. You need to be strategic with your pricing. With homes taking longer to sell and overbidding premiums shrinking, an intelligent pricing strategy is more important than ever to attract the right buyers quickly. For buyers, this is the most opportunity you've had in years, and it's time to act. 30% higher inventory than last year means more choices for you. Longer days on market gives you more leverage to negotiate. And yes, interest rates are a challenge, but they're not much different than a year ago. And if you're buying into a market with this incredibly strong fundamentals, you're going to be supported by our world-class tech economy that is transforming and adapting, not declining. So the bottom line is that the San Jose market is navigating the national economic shifts with remarkable strength, driven by a unique and powerful force of our chronic California housing shortage. I hope this update gives you clarity when you need to make smart decisions. If you're thinking about your next move and want to build a strategy that fits your goals, my contact info is in the description below, or you can scan the QR code on the screen to book some time to talk directly with me. Now, don't forget to like and subscribe, and I'll see you next quarter with more real San Jose housing market data.